Are you confused about whether to buy individual stocks or go for ETFs? Don't worry, you're not alone. Today, we're breaking down the difference between ETFs and stocks in the simplest way possible, so you can decide which is better for your money. We'll explore how each works, the risks and rewards, and why one might make more sense depending on your goals. By the end of this video, you'll have a clear picture and the confidence to start investing smartly without guessing. Let's find out which path fits you best. Today, we will talk about ETFs versus stocks, which is better for beginners. So before we start, make sure to hit the like button and subscribe to my channel. 1. What are stocks? Stocks are shares of ownership in a company. When you buy a stock, you own a small piece of that company and may benefit from its growth and profits through price appreciation or dividends. Stocks allow investors to participate in a company's success, but they also carry risk. Prices fluctuate daily based on company performance, market conditions, economic news, and investor sentiment. Individual stocks can offer high rewards but are also more volatile, meaning they can gain or lose value quickly. For beginners, stocks are a straightforward way to start investing, but picking the right company requires research, patience, and risk management. Understanding stocks involves recognizing that while they provide opportunities for wealth creation, they also come with potential losses, especially if the company underperforms or the market experiences downturns. Properly managing risk is essential for long-term success with individual stocks. 2. What are ETFs? ETFs, or exchange-traded funds, are investment funds that hold a collection of assets like stocks, bonds, or commodities. When you buy an ETF, you gain exposure to all the underlying assets in a single investment. ETFs are traded on stock exchanges, similar to individual stocks, and their price changes throughout the trading day. They can track an index, like the S&P 500, or focus on sectors, industries, or international markets. ETFs provide diversification automatically, spreading risk across multiple assets, which can reduce the impact of any single investment performing poorly. For beginners, ETFs are a convenient way to participate in the market without researching and selecting individual stocks. They offer low-cost exposure, liquidity, and simplicity, making them a popular choice for long-term wealth building. Understanding ETFs helps investors see how pooled investments can balance growth potential with risk management effectively. 3. Key differences between stocks and ETFs. Stocks represent ownership in a single company, while ETFs represent ownership in a group of assets. Stocks can provide higher returns if a company performs well, but they are riskier because poor performance can lead to significant losses. ETFs reduce risk through diversification, spreading exposure across multiple companies or asset types. Stocks require active management, researching companies, monitoring earnings, and evaluating market conditions. ETFs are more passive and can be bought and held over time, especially index-based ETFs. Costs also differ. Individual stocks may incur trading fees per purchase, while ETFs often have lower annual management fees. For beginners, understanding these differences is crucial because it influences strategy, risk tolerance, and time commitment. Stocks may appeal to those seeking higher growth and willing to research, while ETFs suit those who want simplicity, diversification, and steady long-term growth. 4. Risk and reward comparison. Investing in individual stocks offers higher potential rewards, but it comes with higher volatility. A single stock can skyrocket or plummet based on company performance or market news. ETFs generally carry lower risk due to diversification, spreading investments across many assets, which stabilizes returns. However, ETFs typically provide moderate returns compared to high-performing individual stocks. Beginners must balance risk and reward when deciding between the two. Higher risk can lead to higher profits, but it can also cause emotional stress and potential losses. ETFs reduce emotional decision-making because their diversified nature smooths out extreme fluctuations. Choosing between stocks and ETFs depends on your risk tolerance, financial goals, and investment horizon. Beginners benefit from understanding that risk is manageable with strategy, and diversification is one of the easiest ways to protect investments while pursuing growth. 5. Cost considerations. Costs are an important factor when choosing between stocks and ETFs. Buying individual stocks can involve brokerage fees per trade, which can add up if frequently trading. ETFs usually charge an annual expense ratio, which is a small percentage of your investment used to manage the fund. While the expense ratio is ongoing, it's often lower than the combined costs of managing multiple individual stocks. Additionally, ETFs may provide dividends and reinvest them automatically, saving time and effort. Understanding costs is important for beginners because fees directly reduce overall returns. By carefully comparing costs, investors can choose the most efficient way to grow wealth. ETFs often provide a cost-effective way to achieve diversification without managing many individual investments, while stocks may require more hands-on attention and associated expenses. 6. Time and effort required. Stocks require active management and research. Investors must analyze company performance, read earnings reports, monitor news, and make decisions about when to buy or sell. ETFs are more passive. Once purchased, they often require minimal monitoring, especially index tracking ETFs. Beginners who lack time, experience, or confidence may find ETFs easier to manage. Time commitment is a key factor in long-term success. Investing in stocks can be rewarding, but requires constant attention to avoid losses. ETFs allow investors to focus on broader financial goals without obsessing over daily market movements. Understanding the time and effort involved helps beginners choose an approach that fits their lifestyle and financial objectives, making consistent investing more sustainable and less stressful. 7. Long-term growth potential. Stocks have the potential for higher long-term growth if chosen wisely, especially growth stocks in emerging industries. ETFs, while slightly more conservative, offer steady growth and reduced volatility through diversification. Beginners looking to build wealth over decades may benefit from starting with ETFs for safety, then gradually adding individual stocks as knowledge and confidence grow. Both strategies allow for compounding returns if profits are reinvested. Understanding growth potential ensures that beginners set realistic expectations and adopt strategies aligned with long-term financial goals. Combining both approaches can balance security and growth, maximizing returns while minimizing unnecessary risk. 8. Diversification and risk management. Diversification is a major advantage of ETFs. By holding a basket of stocks or assets, ETFs reduce the impact of any single investment performing poorly. Individual stocks carry concentrated risk, meaning losses in a single company can significantly affect your portfolio. Beginners often underestimate the importance of diversification, exposing themselves to avoidable risk. ETFs simplify this process, making it easier to build a balanced portfolio. Even those who prefer stocks can use ETFs to complement their holdings, spreading risk and stabilizing returns. Understanding diversification is critical for managing risk and maintaining financial stability over time, especially for novice investors navigating volatile markets. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.